Canada's traders flexed their muscle in the latest quarter. The country's largest bank beating profit expectations by a wide margin in its fiscal third quarter with record earnings in its capital markets business. That helped offset some weakness in other parts of their business. Royal also setting aside less cash for potentially bad loans. Want to get some more perspective on the RBC quarter and banks generally during this earnings season. Greg Taylor joining us, Chief Investment Officer at Purpose Investments, and he oversees about $2 billion of the $10 billion in assets under management at Purpose. And you guys have more than $500 million invested in Canadian banks, so you watch it very closely. Greg, what was your reaction to the Royal numbers?
Well, I think the Royal number has been spectacular this morning that we're looking at, and I think it goes to show that Royal is still one of the best-in-class banks globally. They did a tremendous job last quarter building provisions, and then this quarter when they were able to release a lot of those provisions and then had the strength of the capital markets business on top of that, I think this goes to show a long way to show the strength of Royal Bank and why it's deserving of the premium multiple it gets.
You know, we came into this period knowing that there was likely going to be some strength coming from the capital markets businesses of RBC and the others. I guess the other question, though, was with the uncertainty around the economy and what's happening on Main Street, the amount of money that has to continue to be set aside for bad loans and how that would impact the bank's businesses and their bottom line performance. What's been your general assessment on that part of the story?
Well, certainly the capital markets everyone knew was going to be good. Certainly when we saw the U.S. banks report a few weeks ago, that was the strength of their business. And everyone knew that was going to be good when you saw that the big trading volumes, the retail had come back and was investing in stocks. And we saw a fairly good number of IPOs and capital raises. So everyone kind of knew capital markets was going to be good. But I think it's still a little surprising to the upside. Normally people don't pay up for capital markets when they're valuing banks because it's usually something that fluctuates a lot and it's not viewed as sustainable. The big thing, as you pointed out, is on credit. And everyone was trying to figure out when last quarter, when there was so much uncertainty in the economy, how the reopen's going to go, and all the banks had to put up huge PCLs, which are the provisions for credit losses. The big question was going to be, how did the banks do on estimating this, and were they more conservative or more aggressive? Royal was viewed as being very conservative last time with a PCL number almost at $3 billion. And the fact they came in this quarter with a PCL in the $675 million range, I think just shows that they were well ahead of this, and now they're able to take a lot of those credit provisions off. Now, the big question that everyone's going to ask is this sustainable? And given that there's so many government stimulus programs in the economy, once they start to be removed, will we have another hiccup further down the road? And that's what I think all the questions are going to be on the calls with them talking to the banks about mortgage deferrals, payment plan deferrals, and if once those come off, how the banks will be able to get through that.
Let's give an example in the case of Royal Bank. If you look at, for example, their Canadian personal and commercial banking unit, which typically is the largest source of profit, there we saw earnings fall about 17%. How vulnerable do you think that business, or for any Canadian bank, that part of their business will be depending on where we are on the economy front by the end of the year?
Well, for sure. And that's the core of all the banks, and that's what everyone's going to be super focused on. And I still think it's a little too early to tell because we still have to figure out what the government programs are going to be across the board and the timing of when they come off, because there's been so much written about the mortgage deferrals and how that's affected housing. And housing is such a big part of commercial and consumer banking that once we get some changes to those programs and starts to normalize, and can people, when we take the training wheels off of the economy, start to function normally again, I think that's going to really play into the banks. But net, the banks are in way better shape than I think we feared coming out of the Q2 earnings. Their capital levels across the board have risen. And I think those conversations that we had worried about what are the dividends sustainable, those feel like they've gone away right now.
Okay, let's just stay on. I know a lot of our audience is very interested in the dividend side of it. So based on what you're seeing, outside of those who have already announced some changes with dividends in the Canadian banking sector, you think the banks are in a position where they don't really have to make any changes to dividend policy?
Well, so far they haven't. They've all come out of this quarter, so far the four that have reported, with stronger capital provisions, capital levels than they had going in. And I think that just goes to show that the dividends are really sustainable at these levels, as long as there's no more bumps down the road as we go through the second half of the year. The other big positive yesterday that happened, and that's why I think BMO was up so much yesterday, was that BMO was able to remove their discounted DRIP program. The DRIP program is a dividend reinvestment policy where they were offering increased shares if you took that. So it was essentially a way of issuing equity. And I think that started to concern people when that was launched in March, wondering, are the banks really going to be okay? Do they have to issue equity to keep their capital levels higher? And the fact BMO was able to remove that yesterday, I think that was a huge boost of confidence because they would have had to get regulatory approval to do so. So that just goes to show the capital levels in good position for the banks that have reported so far. And that should show that with this improvement, that these dividends are safe. And in a market where it's hard to get a good yield, when you're looking at a Canadian bank that can yield 4 to 5%, that's something I think that should catch people's attention and could cause the sector to go for a bit of a run here.
Just a final quick one, Greg, because we mentioned that Purpose has more than $500 million invested in Canadian bank stocks. RBC is one that you guys generally have liked. TD is another. We're still waiting for TD's results. I think one of the takeaways from Scotiabank this week was that if you're dealing with uncertainty in other countries away from Canada, such as their international exposure, that's a wild card for your performance. TD, of course, has a lot of U.S. exposure, and we're not quite sure what happens on the COVID-19 front. What would you say about the exposure outside of Canada for any Canadian banks?
Well, certainly the Scotia quarter yesterday and the Latin America questions is something to be concerned about. But when you're looking at Royal's numbers today, they have a U.S. operation, and that seemed to not be a big problem. TD should be okay. Certainly, they have a lot of exposure to U.S. retail investing through their wealth management division, and that should be something that should set up for a strong TD quarter tomorrow. Certainly, when you're looking internationally, it's harder to get a reading through, and that's for more variability for sure in these quarters. But so far, so good, and it looks like the bank should be all right.
All right, Greg, thanks very much. Greg Taylor joining us with the latest on the busy quarter that is the bank earnings so far, and more to go. We'll look forward to getting more perspective on what's going on.